Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, to make it actionable, understandable, and clear. Whoa, what a week. And therefore, what a show. We are talking about high-level stuff on the podcast today. A viral doomsday report. Ooh, this hit my text feed from a friend of the show, put out by a group called Citrini Research. Just shows how far down the rabbit hole AI can take the stock market, so they think. We're then going to look at another friend of the show sent this article. We're going to be looking at a Yale professor's views on asset allocation. How much should I have in stocks? How much should I have in bonds? Sneak preview, he wants more in stocks. And then in closing, CNBC article, fewer active managers beat index funds last year. And they want us to think of them as helpful tools in our portfolio. Of course, that triggered me, seeing that active funds could be helpful, but we'll get to that at the end. At the top is a Wall Street Journal article by David Uberti. Headline, Viral Doomsday Report lays bare Wall Street's deep anxiety about AI future. Citrini Research's thought experiment rattles investors already wary of tech disruptions. So this I found pretty fascinating. So I got this article sent to me. I did not think it would have much of an effect, nor did I think it would show up in the Wall Street Journal. I was wrong. So there was an article sent out. This is Citrini Research, a group I'd never heard of before, that gives us a glimpse into the future. So they write the article from June 30th, 2028, and it starts with the unemployment rate is up to 10%, 10.2. The market sells off 2% of the number, bringing the cumulative drawdown in the S&P 500 to 38% from its October 2026 highs. So they're kind of scaring us, aren't they? What this article goes into in detail is just the profound consequences of AI and these various agents taking white-collar work and therefore hurting the American consumer, which is 70% of GDP. So one of their points they make, if they say this, it should have been clear all along that a single GPU, those are these graphics processing units, cluster in North Dakota generating the output previously attributed to 10,000 white-collar workers in Midtown Manhattan is more economic pandemic than economic panacea. Their warning in this report is that all this positive, this euphoria related to AI could actually be disastrous for the economy because it could, here they go, they say a 10% unemployment rate in not too long, June 30th, 2028, and therefore the consumer is in really bad shape. It's going to hurt the economy. They talk about defaults, and we're seeing these articles right now, but a lot of these private equity-backed software deals that assumed software as a service would continue into the future without interruption. I see a lot of those loans will go bad. Again, this is a kind of fictional article from the future. What it did is it captured the zeitgeist of the era, which is that AI could do some terrible things to the traditional way we measure economic growth, and we look at the economy and the stock market. So if you're interested, you really have some time and you want to get into the minutia on this, you read the actual article. So Wall Street Journal is talking about this research article, and what it shows is another thing in the article that Citrini put out is it shows these artificial intelligence agents. These are very capable, and they're even capable today, models that can do work that would simulate the work of a real white-collar worker that's in there doing work that we would consider high level and therefore paid commensurately at a higher level. They're saying if we continue on this trend, this is an article from the future, that we will be able to have agents that are far superior to humans in not that long a time. Okay, are you scared yet? Because that was kind of the goal. This is a possibility. Here's the risk that I see. Because all this stuff, it is possible. It's all possible. This could certainly be the way it works out. I don't know. In the early days of the internet, all sorts of predictions were made. In the early days of the locomotive, all sorts of predictions were made. Most were half true. Most of the experts did not know what was going to happen and could not foresee what was going to happen. As investors, I think you've got to be very careful. And no surprise, my advice is do nothing. I think there will be continuous, I'll call it a little bit of fear-mongering. I thought this was a fine article and very interesting to read, but there will be continuous fear-mongering, and you'll be told you're a Luddite for simply hanging in there and doing nothing. But let us not forget the great Jack Bogle, what he said. There's an old phrase, and you've probably heard it before, don't just stand there, do something. You ever heard that? Bogle inverted it and said, don't just do something, stand there. Did you catch the difference? Bogle always had a fun way of telling us to do nothing. He would say, don't just do something, stand there. Just stand there. Let the articles like this, there will be more like this, because my anticipation is that we will have more and more aha moments without a clear understanding of the economic and stock market impacts. But none of it's actionable. Let me tell you, if I could predict it or someone else could predict what was going to happen, they would. And they'd make a ton of money, but it ain't that easy. It just ain't. So this article gives this real world, I mean, it's kind of amazing. This report, IBM had a 13% decline in one day. Worst day performance since 2000. They attribute this article to, in part, why it happened. Software firms, Datadog, CrowdStrike, Zscaler, they each plunged more than 9%. This is when it's hard not to believe these articles and get caught up in it a little bit. You can get caught up in some of the emotion. Don't do it. It reminds me to the upside. In the late 90s, in the internet age, you'd have an article or a message board come out and the stocks would go up 5, 6, 10, 15% in a day. Well, this is the inverse. Technology is coming along and people are realizing, there's a potential that a lot of what underpins the economic moats of these companies is going to go bye-bye. Well, you're hopefully in an index fund or well-diversified, so don't hop around. The worst outcomes I see are when people make fear-based or greed-based decisions real quick. So don't just do something. Stand there. And then an article the Wall Street Journal had that was fascinating. Well, a Yale professor talks about the importance of having your asset allocation correctly. So this Yale professor, Mr. Choi, outlines a formula that incorporates income, risk tolerance, and other factors that are absent from typical rules of thumb. Now he's comparing, I'll give you the rule of thumb that I think is a bit of a straw man, but it is the historic way of thinking about asset allocation. You may have heard of it before. You take your age, and that should be your bond allocation. So, for example, if you're 25 years old, you need 25% of your assets in bonds, 75% in stocks. This was the old way of looking at bond allocation. If you're 50 years old, you know it's coming, 50% in bonds, 50% in stocks. If you're 70 years old, 70% in bonds, 30% in stocks. This is one of the kind of horses to beat, he says, is no, that's way too conservative. He's right. He then looks at the Vanguard target date funds. He uses 2065 and 2040 as examples, as well as the retirement fund, and says, well, all right, what is their stock allocation at a certain age? So for that 25-year-old worker, 91% are in stocks, but for his formula, it's 100% in stocks. And if we switch over to a 50-year-old, you'll remember the old formula was, hey, you need 50% in bonds. Well, the Vanguard fund had you in about 25% bonds. So Vanguard was a little more aggressive. Mr. Choi, it just depends, but he could have you up to 88% stocks at that age. Again, depending on your particular risk tolerance and where you are with your balance sheet. A lot of this I see this as just common sense. I think the formula makes people feel better sometimes. It's a warm blanket to know, oh, good, there was a bunch of analytics involved in determining my asset allocation. I think sometimes we can overthink it, but it's good to have the analytics. And then they give the example for a retired couple, 70 years old. The old adage, if you're 70, you need 70% of your asset allocation in bonds. Well, no, Mr. Choi says you could have up to 64% in stocks if you have a higher risk tolerance. I think that's fine too. Now, Vanguard puts you in their retirement fund at 31% stocks if you're 70 and retired. I will say this. I agree. Mr. Choi, I think you were right. Higher equity allocation is probably appropriate for many people. However, these sorts of articles tend to get written when the stock market has gone up for a long time. You start to see studies come out almost as a kind of a result of this, is that, people weren't reading studies that you need more stocks in 2009 or 1929. These articles didn't see the light of day. They were right. In fact, in 1932, you needed lots of stocks. If you listened last week or the week prior, or in 2009, you needed lots of stocks. But that human behavior element, we've got to be so careful with. So I do think he's right. I think this is an interesting article. Great. Have more equity allocation. My warning is people want to talk themselves into taking on more risk than they should. And if Mr. Choi gives them the excuse, they'll feel like it's a stuffed animal. Great. There's a formula. And the guy he's a professor at Yale. I love they would say a Yale professor. They don't say, now I'm going to offend someone's alma mater, but a lower tier university professor investment formula. What if it said an elementary school math teacher has an investment formula that says you need more stocks? Wouldn't quite hit, would it? Wouldn't quite pop. But no, it's a Yale professor. So be careful. Be careful. The optics can lead us down roads we shouldn't go down. So I like doing this under the care of an hourly financial advisor. My experience is very few of us see ourselves rightly and can make the right assessment, self-assessment of our own risk profile. I don't even let people self-assess risk. That's how bad I think humans are, myself included, at it. How risky are you from a scale of 1 to 10? I don't think anybody can answer that very well. I want to know, how have you handled risk in the past? And it's hard if someone's 22. But if someone's older, you've got a track record. You kind of know. The best predictor of future behavior is past behavior. So I don't want to know what you want yourself to do in a market downturn. I want to know what you did in a downturn and plan accordingly. At the end of these bull runs, or as the bull run keeps going, stocks keep going up, people will convince themselves they need huge equity allocations. And be careful that a Yale professor doesn't talk you into it. Again, good article, valid data. I think probably actionable for some folks, but dangerous for others. And then in closing, CNBC article by Sarah Agostino, headlined, "Fewer active managers beat index funds last year. Think of them as portfolio teammates, not rivals," CFP says. So this was a trigger one for me. I'm thinking, just when you think you've taken out the last bastion of proponents of active funds, you get a CFP to tell you, nope, they're teammates. I'll try to be as fair as possible in the article, but over 10 years through last year, it says 31% of active funds in the cheapest quintiles of their respective categories bested their passive peers. So they're basically saying, I'll translate this, compared with 70% for the prices fund. So the lowest cost active funds, 31% beat them. Oh, so the pattern is cheap wins, not active passive. It's cheap that matters. There's a quote here, "I don't treat passive and active funds as rivals," said CFP Mike Casey, founder and president of AE Advisors in Alexandria, Virginia. "I treat them as teammates." As you know, I do not. I don't understand that statement at all. But I think we need to give him his day in court. They show the percentage. I use the Spiva report. They're using Morningstar. I didn't know this. Morningstar has a semi-annual active passive barometer. The analysis evaluated the performance of 9,248 funds. So I'd probably stick with Spiva report, but this still says what we know to be true, which is active funds lose by a wide margin to their index peers. And they lost by varied amounts over a certain number of years, but they lost. Bonds, they got close. Bonds were closer. They lost, but they got a little closer. So not a great success rate across any asset category. However, somehow the conclusion is reached that these are helpful partners in your portfolio. How would you reach that conclusion? Well, not totally sure, other than one of the reasons given is, hey, you can partner these active funds with passive because active funds will know, and this is the bond side, how to manage duration risk. That's the risk that the move in interest rates will move the value of your bonds commensurately, and so you can reduce duration risk if you're savvy and you can move at the right time. You don't need an active fund to do that. You can just buy an index fund with lower duration or higher duration, or I don't think you should mess with duration at all. Just buy the ETF BND, which is the Vanguard bond index that is really large. It's about I believe it's a 7-year duration or so. It's great. One of the real risks in this, oh great, I'll partner with active, we're here, and then I'll use passive for the core. You're going to be constantly tinkering with this. Because of course, as a rule, you will be rotating in and out of these active funds because so many will fail. The failure rate is very high. So you'll be looking for managers. You will be constantly hunting to ensure you found the right partner for your passive funds. Waste of time, waste of money. One of the quotes here that I just wish they would extrapolate further. Sometimes they're so close. Say this: passive funds shine when markets are highly efficient and cost matters most. This is a Mr. Casey who said that. And I think to myself, markets are efficient. When are public markets not efficient? Who told these folks, Mike Casey, founder and president of AE Advisors, who told you that markets were inefficient and that somehow active helped with efficiency? This is one of the great misunderstandings of how markets work. And listen to this, as more and more investors elect to go with index fund, the market becomes more efficient. What? How is that possible, Robert? There's a great quote, but I think it's Jack Bogle again. It says, dumb money ceases to be dumb when it recognizes its limitations. And when we put money into an active fund, harsh words I know, that's an unintelligent decision. And if we try to pick stocks on our own, we are being unintelligent. We're not being data-driven, evidence-driven. So when you just throw in the towel and you say, forget it, I'll just go index funds, you're left with all these professionals, all these AI bots, placing trades, competing with one another, trying to scrimp a little alpha out of a publicly traded market, which, by the way, as AI gets better, is only going to get harder, not easier. Harder. I would be shocked if humans are picking stocks at all, unless AI will be really good at this if people haven't already realized that AI can do it in a superior manner today. So you don't need active funds as garnish and the main course passive. Just stick with passive. Just stick with it. If you ever get caught up and are worried you'll be tempted to get involved with an active fund, just Google the Spiva report. Just type in SPIVA, Spiva report 2025, or latest Spiva report on Google. It's S&P's website. Just read it. And it ends up telling you, hey, over 20 years, there's about a 7% chance that your active fund beats the index. These are odds you would never want to get excited about, that you'll never see in the advertising, by the way, for these active funds. And so you need to see rightly. Don't see what the active fund managers want you to see. And you know what that is. It's keeping your costs low, investing simple, and time horizon long, because that is what's going to give you the best shot on your investing journey. Until next week.